Thank you, everyone, for joining us today. I'm Joe Breeden, CEO of Deep Future Analytics and Prescient Models. I'm joined today by Walt Aegis, CEO of CU Sol. We'll be talking about strategic planning in a pandemic. Glad to be joined by Walt because he has a lot of good insights on this. So, Walt, can you say hi, introduce yourself a little?
Sure. Thanks, Joe. Good afternoon, everyone. Walt Aegis with CU Sol and also CU Lending Edge, CEO of two QSOs and have been for about the last 3 years. I do have quite a bit of background in strategic planning. I ran a whole business to do that for a number of years. So I'll just hit these really quickly, these points. And then at the end of this presentation, if we have time, I'm going to tell you this little Albert Einstein story. But maybe reinforcing some of the key strategic planning issues and thoughts and takeaways that strategic planning should be all about planning for change, getting your organization to the next level. So we'll be talking about that today. Critically in planning, just like any kind of journey or travel, you need to know where you're at, exactly where you are today to efficiently get to where you want to go. So one of the key takeaways from today is going to be how to utilize some of that data and where you are today to get you where you want to go. I'd like to be able to just at some point address dysfunction. It's a normal process of life for everyone. All organizations have some dysfunctions. And as we get into that and talk about it, maybe in a couple different slides, we can just talk about how and why maybe this is a great time to address some of those things that we know are part of our organization that we'd like to change. Clarifying expectations and direction for your organization, metrics, making sure that we're measuring the right things, because we can measure a lot of things, but if we're not measuring the right things, it may or may not be very helpful for us in terms of getting where we want to go. Being able to build and maintain consensus, and consensus is when 4 people vote for something and 3 people vote against it, and the vote passes or whatever's happening through strategic planning, even if the whole room isn't in unanimous agreement, consensus just means, hey, we're going in this direction and we're going to support that the best we can, even if we don't 100% agree with it. And for strategic planning to work well, you really need to work with that consensus model. And then we're not going to really get real heavily into the board jobs. Typically, a lot of these types of sessions are attended by board members. But if we need to, if there's any questions on that come up, we can talk about what is the real role of the board in the strategic process, and basically these 3 things that we have here. And then, as I said, at the end, I'd like to be able to tell you this little story. I think it'll bring some perspective to the group in terms of and some real relevance in terms of what strategic planning is all about. So with that, let me kick it back to Joe.
Thanks, Walt, and thanks for the background. What we want to do through this webinar is kind of step through some of these topics. So what kind of information do we have about where we are? What can we do? So you'll see these items come up again. So we're going to start with, where are we right now? And I think it's fair to say that the data we're seeing is starting to look like settling into the new normal. We've been talking about the coming of a new normal for some time. So what does that look like? Well, let's start with the virus, because this is what drives it all. Now, we know about the mid-July peak in cases, the rapid increase through late June and early July. A lot of that was irrational exuberance, to borrow a term. We kind of declared victory too soon, and people forgot that the way you keep this down is social distancing and wearing masks and all these things we've been talking about. So you saw a real turn in July, and we are on a continued decrease in that now. That's great news. In fact, a quicker decrease than we had before, but from a greater amount of spread. So that decrease is not happening through massive shutdowns and things like we tried to do before. It's just through individual responsibility. which is another way of saying that people are starting to get the idea of what this new normal is going to look like. Now, the headlines still talk a lot about universities that are having to close, and really it's unfortunate because I'm sure that what you're seeing is 99% of a student population gets the point and is trying to do the right thing, but the 1% is not behaving properly. And that's all it takes is 1% not behaving properly for the disease to spread if you're in a high density situation like that. So that's the challenge with schools, whether it's universities or high schools or elementary schools or any other high density setting. So most of what's causing this to come down is just the general population getting smarter about these things, but we're not going to get rid of it completely unless we do things that are really dramatic. So I think it's fair to say this isn't going to go away. We're going to get down hopefully to a much lower level, but it's going to be a slow burn. People talk about this as a wildfire, and instead of a raging fire, this is going to be more of a brush fire for a while, and probably until we can start mass vaccination sometime mid next year. So what does this new normal look like economically? There are a few sites that we look at. The traditional economic data, and I always think of FRED, the Federal Reserve Economic Data Repository, as a source of traditional data because they pull together all these different government agencies. And the problem is a lot of that data is reported monthly or quarterly and with a significant lag. Only a few things are reported in a timely way, like unemployment insurance claims. So some of this other data we can get, we don't have long histories with. It's not typical economist reported variables. We don't really know the data quality, but there are groups saying, hey, this group called Womply is processing credit card transactions. And so this is what they're seeing in their footprint. And it's useful to know. If you look at this data from mid-June through to the present, it's very flat. So spending at lodging, so your hotels and motels and all the rest, that is being compared year over year. So if I look at it this way, hotel occupancy rates, that you can see there's strong seasonality. If this pattern holds, then we may be seeing a reduction in spending at hotels through the fall as kids are back to school one way or another. But still, this previous line is showing that's a pretty flat line. And it implies that we've kind of settled into a mode of behavior corresponding to that decreasing trend on the rate of infection. And it's about 40% below normal spend year over year. If we look at spending at local restaurants, you know, hotels and restaurants or bars, things like this are some of the key indicators we're looking at to see how are people behaving. You can see that in fact, it has come down a little bit from a June peak as people got more cautious. What's happening in August? Not exactly sure. We have to get a little bit more data to see why that's come down even more. But I have to tell you, I'm impressed at the innovation that we're seeing. In an early webinar, maybe back in March, we said to settle into the new normal, we're going to need business innovation. Businesses are going to have to figure out how to do a low density, high health and safety business model. And we're seeing that. I drive around our little town in Santa Fe, New Mexico on a Thursday night or a Friday night. I'm surprised how much nightlife there is compared to what there was before. But that nightlife is restaurants have changed their name to put patio on the end. And now they've converted part of their parking lot into a patio, or what used to be a meeting space on a balcony is now the new restaurant, where the old restaurant is just food prep and wait staff. That's good for now. We don't know what's going to happen when it gets colder. In southern states, maybe they can keep that going for a while. Northern states, restaurants are going to suffer this winter. We know that. But this kind of innovation is what we're going to need for the next year, figuring out how to go on with our lives. I'm looking forward actually to taking my wife out to one of these new places outdoors where it's sunny and safe in the breeze and enjoy life a little. So hopefully that's what this new normal is going to look like. Now, that mode, a significant reduction in spend doesn't support the number of businesses we used to have. Now, here's data on businesses closed. It's not the same as permanently closed or bankrupt. So you can see some of these things like health and beauty services is the one that had the highest rate of closure back in April, one of the strongest recoveries. It is trending up a little bit towards more closures. We'll see some of these businesses will have trouble staying in business long term with reduced traffic, reduced spend, and several other of these measures are trending up. So this rate of closure based on credit card spend is going to be related to Chapter 11 filings. Now, here's a July to July comparison. And so you can see 2020 July has a lot more business bankruptcy filings than previous years. And we expect this to grow. We're not back to the levels of the last recession. I think some businesses are still working through the cash they got through PPP and idle loans and other avenues available, but I think we all know there are going to be more closures. So we'll want to track this to get an idea of what the future looks like there. And then where are things going to go from here? So Walt, you're the expert on strategic planning, but I've got to say it to me, the way to do strategic planning is you've got to have timely data. You've got to have as much information about your local market as you can, but you also need to look at the possibilities of what comes next. So we've got a service called Scenario AI that is generating economic scenarios using machine learning methods. And these scenarios, we're mirroring what you see a lot of economists talking about, V, U, and W shaped recessions. The V is the most optimistic. And so here's cumulative GDP. If we really have a V-shaped recession in about a year and a half, we might be back to the level of GDP we had at the start of all this. Honestly, that's pretty optimistic. A U-shaped recession, basically things don't ramp up quite as quickly, gets you about halfway back to where we were. The W recession is kind of the worst case. Well, that's the worst case here, obviously. It's where things really languish, that we're not able to restore confidence, that we don't really get back to business. There are plenty of economists who think that the winter is going to be hard, as we were talking about restaurants and other businesses, that it's going to force a lot more closures because Q4 is often a quiet season before you get into Christmas spending. And so, the risk of a W recession is still very much there. My own personal bet is that we're still somewhere around this U recession. I think V is too optimistic given the troubles we're seeing, that we're going to settle into something, this new normal that's not quite that. So we need to think about this in our business plans, how we're going to run our credit union. So
and let me make a comment or two on this, Joe, if you don't mind.
yeah, absolutely.
I think in my background, just briefly, I'm running 2 different QSOs today. I've done that in the past. I've been a credit union CEO. I've been a strategic planning facilitator. So I've seen this literally from all angles and all sides of the desk. And doing strategic planning is never an easy process. There's always a lot of unknowns. I think this is the most unusual time in the 25 so or 30 years that I'm involved in credit unions. It's the most unusual time that I've ever seen. In the best of times, very few of us are really good at predicting. If we were really good at predicting, if I was really good at it, I'd be living on that island out somewhere on my own and would have made billions of dollars by now. So, none of us are good at predicting, and we're not trying to predict in this type of a scenario, but having the data, having good data going into this type of planning session under these conditions, I think is more critical now than ever. And I think also being, this is going to sound funny, but if I were in front of all these participants and doing their planning this year, I'd say this might be the one time, if you've never done it, where of course after strategic planning you build your budget and you try to stick to that. But I would suggest being extremely flexible in your strategic plans and in your budgets this for 2021, because it is highly likely that no matter what we think is going to happen today, it's probably not going to happen. And we need to be able to be, I think very flexible as you move through this process, both this fall in your planning and certainly even in your budgeting for next year. I think those are just really critical points. And again, it might be the first time you've ever strategically planned this way or budgeted this way. But my suggestion would be, no matter what you do, make sure you build into your plan a lot of flexibility, some elasticity for change, because I do think things will be a lot different 6 months from now than what we think they are today. So.
And Walt, let me ask you, do you see people in this strategic planning set thresholds and say, here's our plan, but if things go this way, and you know, talk about a certain metric, maybe it's that local unemployment rate or you know, something else that matters to your decision making, say, if it gets worse than this, then here's going to be the fallback plan, and let's agree now. Because my experience is that in the moment of a crisis, it may be harder to get agreement than at this moment, where you can look forward 6 months and say, if we haven't recovered this much by then, they're going to have to take this next step, and let's agree on that now.
Yes, I think that's really critical. Having the metric and planning to be flexible, and this might even be addressing some of the board dysfunctions that happen, or just organizational dysfunctions that happen. You know, trying to adjust that at the time when it's very critical. Generally, we don't make our best decisions under those circumstances. So the ideal scenario is to be in a strategic planning session, talk about the what ifs, and you know, you're not going to carve it in stone, but talk about the what ifs and say, you know, if this happens, then we'll be flexible to go that way, or vice versa. But choosing those right metrics are going to be critical this year, and they're probably going to be different metrics, probably in some ways different metrics than you've defined in past years, because the circumstances right now are just vastly different than any of us have ever experienced. Nobody alive today has gone through this that I'm aware of. And there may be somebody that was a baby in 1918 that went through the Spanish flu, but this type of epidemic and this type of economic scenario, nobody's gone through it. So we're all learning. We're all going to learn from it. And I think just the best course of action is to be flexible. And again, if I were back at a credit union as a CEO, if I had the kind of data that we're talking about today and could bring my data into the picture, use some of the analytic tools that are available today that weren't available back then, if I can make one really good decision that sticks, that lasts in my credit union, even for 2, 3, 4 years, that's going to pay for any cost and any time of having my management team acquire the data, analyze the data, and talk about it. So I think just one or two good ideas that come out of this year's planning for you that you can actually implement. Those are the credit unions I think they're going to have really successful sessions this year as they move into next year for their budgets. So I just want to make that point.
Mm-hmm. That's great. And another thing to think about, so we've been looking a lot at unemployment trends, insurance claims, those sorts of things. There was some analysis that came out just this week where people are starting to look at what is the permanent job loss. You know, in an ideal scenario, basically in that V-shaped recession, we would hope that by kind of temporarily supporting people, businesses could reopen, they could have their jobs back, and the wheels would start turning just as they were before. But It's already clear that's not going to happen exactly that way. Nobody's really surprised. Um, we're starting to see some of those temporary job losses convert to permanent. And so in these graphs, they show the last recession, and you can see there's a large amount of temporary job loss sitting on top of a base of permanent job loss. In just the last couple of months of historic data here, you can see the permanent job loss is ticking up. Economists from Harvard and an economist from the Federal Reserve put together this research. The Washington Post did a nice job summarizing it into three different alternatives. And what you can see is that the pessimistic and the baseline are both roughly getting to permanent job losses on par with what we had in the last recession. Now, their scenarios have for still show quicker recovery from that than what we had coming off that last peak, because there were some severe structural problems that caused that last recession. We didn't have those structural problems this time. We just need to get people healthy. So I think there is reason for this to recover quicker than it did before, but it doesn't mean recover completely. You can see that by 2022, job losses are still significantly higher than where we started, and I think that's fair based on the models we've been running. So another good thing I think it's important as you plan for the future to keep in mind how long a future you need to think about. That this is not something that goes away. It took a while for people to realize this, even the economists. Back in March, we had a lot of economists who seemed to think this would be done by Q4 of this year. Now, not all of them, but enough of them. And from an epidemiological perspective, that didn't make a lot of sense. It's not possible for us to defeat this thing that easily. So yeah, that we need to make sure our plans are looking longer term, not just the next couple of months.
When you talk about that, it just reminds me of something that I use quite often in presentations about the long term. And there's a question you ask is, when's the best time to plant a tree? And if I'm in a group, 50 or 100 people, 200 people, I'll get people say springtime, fall, blah, the answer is the best time to plant a tree, especially if you wanted a shade tree in your yard. That was 20 years ago. So, the best time to plant a tree, long time ago. If you haven't planted the tree, what's the second best time, next best time to plant a tree, which would be now. So you got to plan for the long term. But as Joe is talking about with this data, it's really going to be difficult to do that. So as we're planning for this year, my thoughts would be saying to people, continue to look 3 to 5 years in the future, but I don't think any of us can predict that. So I think a lot of our planning this year is going to be a little different and maybe a little less long term, because you won't be able to be very predictive. We won't know what's going to happen until it happens. In this case, it's not going to probably be like the past. So I'm trying to plant that seed right now to say, if there's things that you have talked about doing, thinking about doing, this is the time to really get those things on the table and hash them out. This is what strategic planning is all about. So,
and I'll add one thought. You mentioned before about how much uncertainty there is, and one way to measure that is to look at the scenarios from economists. Of course, there are lots of surveys out there. You can track this month to month, and the spread of economic projections from economists is far greater than in the last recession at any point through the last recession. So, none of us really know. That's a completely fair statement. And the range of possible futures you have to plan for is much greater than what we've ever had to do, just like you were saying, Walt. And that's true, even in these graphs, that you look at this range from optimistic to pessimistic, that's almost the entire last recession. That's a huge range. So it's just a measure of how little we really know, but it does mean one thing I've had to get my head around is not really to try to be right. We're giving a webinar, we're telling you what we think. We've been doing this over many months, telling you what we think, and guaranteed some things we say are going to be wrong. But what we're doing is saying, here's what it looks like now, but you got to plan for a wide range.
Yeah. We talked about what the data could do, and taking your data as a credit union today, and not just today's data, but past data, and applying it to some of these other trends gives you those economic scenarios, gives you some of the answers. And I know your organizations have changed in the last 5, 6, 7 years, but probably not so much that you can't look at, well, when unemployment did this, what happened to us? When this happened, what happened to us? And how likely is it, if that happens again, how likely is that same thing going to happen to us? You know what your pain points have been over the last 5, 6, 7, 8 years. And one of the takeaways, one of the absolute deliverables from this scenario data and analytics that Joe's talking about is that you can apply some of those questions to your own data. If the market does this, based on what we look like today and how we've performed in the past, what's the likely outcome? So that's where I see the data, this type of data, being extremely valuable for you from not just strategic planning, but budgeting and well into the future. So.
Mm-hmm. Okay, let's look now at the state of lending.
I'm just going to throw a couple comments in here because I'm heavily involved in this business. CU Lending Edge is a QSO. It's a lending QSO. It's part of CU Soul. So the two companies are interconnected, and it's all we do in CU Lending is help credit unions with lending. And most credit unions realize that most of your income comes from lending. It's all, 60, 70%, 80% of the income comes from that. So, when you look at the market today, people are staying in, they're not going out. We're still seeing vehicles being bought. So for example, car buying, but everything is kind of pushed down. But what's really changing is the delivery mechanisms, multi-channel, online. People are shopping online. They're actually getting loans online. We're seeing the lending trees of the world, for example. Those types of processes are prospering. We just saw, if you're paying attention to some of the financial news of the first part of August, Varo, which was basically just a payment processing kind of an online bank, pseudo bank, actually got a real bank charter, and they've got 2 million customers today, and they're coming into our arena. I mean, it's a real fintech that was a kind of a non-bank coming in. And one of the things that they said is they're clearly going to be expanding beyond checking and savings, which to me probably says they're going to get into the lending business, which is our business. And so the trends out there for lending are you need to be online, you need to be more automated, you need to be where the business is being generated. And of course, you still need to be able to pick up the phone. You need to be able to let members walk in the door. But just in general, all of us as credit unions, we need to do a better job of being out there in the marketplace where the business is really being generated, attracting new members, capturing existing members, and recapturing existing members. And one of the key things that I see coming up is, I know it's going to happen towards the end of this year, and as we get into the first quarter next year, you're going to see some real interesting loan participation opportunities, where the originators will actually go out and find buyers and let the buyers dictate the terms. So in the past, what's always happened with loan origination, if you need more loans, is you kind of take what's out there. You just take it or leave it. That's what it is. But when you're going to start to see trends where originators are going to say, well, let's just originate for you 5 credit unions or 3 credit unions, and you tell us what you want. We'll go out there. We've got the regional or the national charters to do it. And it's going to be another way for credit unions to balance out their ALM, to manage their CECL whenever that happens, and to be able to generate the loan business that they want and generate the income they want. So there's a lot of things are happening in the lending side, which again is extremely critical to credit unions. And I would just hope that everybody would be open to saying, let's at least be in the market. If you want to generate more business, you're going to have to be where the business is, and it is kind of the online multi-channel operation today. So those were some of the key things I just wanted to hit on
Hmm.
related to lending.
Yeah, that sounds good. And actually, the one of my favorite things to look at related to lending is the Senior Loan Officer Opinion Survey, SLOOS. And you can look at various measures of demand and underwriting quality. In our own studies, we did a study that was published a couple years ago now, jointly with a researcher at the Philadelphia Federal Reserve. And the self-reported quality of underwriting is not actually very predictive of the quality of underwriting, but the demand is very interesting, both just in volume and in quality that's coming in. Now, this is showing consumer loans and mortgage. And so the gray line on here is showing what we're seeing now is booming mortgage demand. And in fact, they isolate this by GSE conforming, Fannie and Freddie type mortgages. That's at all-time highs. On the other hand, demand for auto and other consumer loan products like credit card are basically at all-time lows. So even though, well, normally when demand is low, we see poor credit quality. That's what our studies have shown in the past. But right now, many patterns are changing through this recession. Even though auto loan demand is very low, the people who are out there who want a car loan see an opportunity. They likely still have a job. Of course, you're going to confirm that they do. Um, but it may be that credit quality is better than normal because of the ability to guarantee good quality coming in through rigorous underwriting. So it's an interesting divergence here between mortgage and other consumer loan types. And it's obvious that what's happening in mortgage is all about refi because interest rates are low. The actual rate of new home purchases is kind of following the seasonal trend. It's not off. It's just where it normally would be, but refi is huge. Um, Now, change in consumer debt, if we break this down a little bit and just look at what the change has been, here's where you can see, again, a lot of growth in mortgage, decrease in credit card is really dramatic. What's happening is that a lot of people are hoarding cash and using the money they've got to pay off credit cards. It's people being as conservative as they can. So your balance sheet is shifting dramatically. We see a lot of people who are putting on all the mortgages they can, but they're losing credit card and auto and other things at the same time. So it kind of pushes you to looking more like a monoline, right? There's a lot of concentration risk in that. You're less diversified than you used to be. But Walt, anything that this strikes
Yeah.
you as?
Yeah, I'm biting my tongue right now, trying to stay quiet. So, couple of things. It's just there's still a ton of business out there that's happening. We haven't seen loan demand slow down on our CU lending edge side. And if anything, it's actually up. Because what's happening is some of your competitors are pulling back. They're a little afraid. And in some ways, we still need to be a little bit afraid as credit unions, but not worry so much about credit scores for both approvals and pricing, but combinations of the data that make up those credit scores, being creative the way we generally have been as credit unions and serving our members. There's still a lot of business out there, and there are a ton of, I'm going to use the word channels, so, and I mean outlets, a ton of different places that loan business gets done that credit unions are not at today. So there's still a ton of opportunity out there. You just need to be a little creative as credit unions. And, call me if you want, and I'll give you 10 creative ideas. Can't get into everything today, but we need to expand our offerings, get out there, compete online, do the things that are necessary, because you don't want to have just mortgage loans in your portfolio. Your CFOs will go crazy. It's actually cheaper and safer for you just to buy CMOs than have all your portfolio in mortgages, even though there's a tremendous amount of demand. So there's a lot of business out there. There's still a lot of good activity. Credit scores are still important, but they probably for a while shouldn't be the most important thing that you're using for underwriting. So it's going to be a matter of being a little more creative. And as we've seen in the past, credit unions that get creative usually do pretty well. I mean, as long as you're not doing anything silly, most of us stand on the sidebar and say, well, that's kind of a dumb thing for them to do. And then 3 years later, we look at them and go, man, that was actually pretty smart. So I think being creative, working together in some ways as credit unions, maybe this loan participation process, diversifying both product-wise and geographically. I think there are a lot of things that credit unions can still do today to attract consumers. We're seeing all these online sources getting a lot of loan business, and they're just taking it away from us. So we just need to be out there in the market competing where the business is, and you'll get the business. I'm confident of that.
Great. And if we look at commercial loans, because of course, credit unions have been putting on a lot more commercial loans over the last few years. This is a rapidly growing part of the business. And what we're seeing is that the demand for commercial real estate loans, CRE loans, is at all-time lows. That's not a surprise. There's such huge uncertainty around the value of a square foot of commercial real estate. And at the same time, not only is demand down, but if we look at commercial real estate price indices, there's a lot of uncertainty around that too. It depends very much on the type of property right now. I'm sure we haven't seen this play out completely yet. The C&I small business loan that loan demand is also down. But in these surveys, I have to say, it's not clear. They probably are including the SBA loans, PPP and ISIL. So they're not down as much as they might be. But again, there is a lot of small business loan demand. The healthier ones who want to survive, make it over this gap, may want short-term loans. And so this is a case where you've got to do a business assessment and see, how are they going to look through the next year of new normal and then after that. But there may be an opportunity there as well.
Yep.
And I mentioned commercial real estate. This is a graph comparing some different indices, and they don't all agree right now. And it's just because, that's still rapidly evolving. We don't really know yet what the value of commercial real estate is going to be. Okay. It's worth pointing out, huge volume of loans are sitting in forbearance right now, and this is going to factor into the comments we have coming up. You've got just under 4 million loans today, mortgages that are in forbearance. And of course, I have to tell you, a couple of months ago, we had data come in, the monthly update from one of our clients. I got an alert from our system that there was a data load error. I called the client and said, hey, we can't find any charge-offs in your data this month. And they said, yeah, we chose not to charge off anyone. We've got 100% forbearance this month. Like, wow, okay. So I'd say at the beginning, there was really aggressive forbearance. Basically, you want it, you got it. The last couple of months, it's getting a lot more selective. Prove that you need it. Show me that you lost your job. Show me what your hardship is. So, and that makes sense. You don't have to give forbearance for no reason, because what's happening, if you don't require proof of hardship, then you're going to get strategic forbearance. And we saw this, people who took it without needing it just because it's a crisis and they wanted to hoard their cash. And so that is playing out. We don't yet know how all this forbearance is going to play out. That's yet to come. But right now, there's a big artificial suppression of delinquency and charge-off because of all the forbearance going on. Okay. There are other measures out there of housing distress. These are worth tracking. What you can see, this is something that is probably going to get worse before it gets better. We all know that nothing's happened in Congress this month about additional support or eviction, moratoria, things like that. So those having trouble making housing payments is on the rise. and probably more of that to come. So we'll have to just keep tracking this. Now, what do we do with all this? It's great to have data. It's great to have scenarios. One thing we're trying to do, and we're doing this jointly with CU Sol, is to create stress tests of the P&L for credit unions. And so we do have a product that you can get quickly based on call report data. We have gone out and basically downloaded all the call report data from NCUA, FDIC, built models that predict changes in loan balances, deposit growth, charge-offs, and flow all these things through revenue and expenses out to P&L items. This is based on those scenarios from our scenario AI tool. And because it's all public data, you can do this on your peers. So if you want to know how is the recession affecting my peers, whether they're local or distant, you know, however you want to look at that, we can run those reports. So when you go into a board meeting, you can say, or you know, your strategic planning session, say, here is what the P&L could look like under different economic scenarios over the next couple of years, and you know, use that as a starting point, not just what the current data is, but where things could evolve for your institution. Walt, any thoughts about that?
No, I think you hit it hard, and we've talked about it in previous slides. I just think this is a time that if you've never done this type of analysis before, it's a time that you should do it. And even if you have done some of this, this is a very unique, what you've developed is a very unique way of doing the data, so that you can do all kinds of comparative analysis. So I just think it's be extremely valuable, whether you're, you know, senior management team or board members. It's just, this is just a unique way to look at the data. I think everybody should be taking a look at it.
Great. I should say that since this is based on call report data, if you want this, you can have it in 24 hours. It's there's no IT requirement. It's public data, so we could just download, run the forecast, and send it. And it's all in Excel, so you can easily generate reports out of it or integrate it. Here, what we've got is just a few graphs pulled out of some of those reports showing the range of potential outcome that you're seeing. This is an example. The data is real because it's public. So for a credit union out there, you can see what does a V, U, and W recession look like related to charge-offs, total shares, coverage ratio, net return on assets, and we've got a whole bunch of other measures available. These are just a few cherry-picked. But with that in mind, let's look at some of the things that go wrong and what we need to deal with. And one item I want to bring up is that even though we want you to have data, we want you to have forecasts and scenarios, you need to also understand the limits of those. And so those forecasts that I showed on that previous slide, they had one other ingredient. It wasn't just economic scenarios, but the models that we have today, and we meaning the entire industry, every model out there is a pattern recognizer. It's looking at what happened in the past in order to make predictions of what should be happening now. And if they're looking at economic data, they're going to say, wow, we just went through, if the data had been reported right, almost 20% unemployment. We're down to 10% unemployment, which is still a huge number. So losses should be huge. Where are the losses? Well, it's forbearance. We've never had this level of forbearance. We've never had this level of government assistance. So it would be wrong to say the model's broken. In fact, I would say nobody's model out there is actually broken. What they're doing is they're telling you what would be happening right now if not for all this assistance. And so it gives you an upper bound. And so this graph on the right, these solid lines are showing the upper bound of what could be happening in losses for this actual institution. But what they're actually experiencing is a much lower number because of all this assistance. And then we've got a tool that says, well, let's run some hypotheticals. based on when assistance ends. Now, we know Congress doesn't have it act together yet. We expect some more assistance, but just look at the mortgage forbearance and a lot of other things. The assistance is not entirely gone. So when the assistance does go away, then the models are going to be right in terms of telling you what the consumer response should be. So until that point, this forbearance and assistance period, we're going to have reduced losses. Some of those hopefully don't come back, that you're going to get these people over this gap so that they can get their jobs back, maybe in 3 or 4 more months. If assistance finally ends, you'll look at what unemployment is at that point and say, that's going to tell me how hard it is for folks. Some of the people who are getting assistance right now, they're not going to make it because their job losses will become permanent, meaning they have to go out, wait for economic recovery, apply for new jobs, and so forth. So those could turn into losses next year. And so the dashed lines here reflect this combination. So this overlay tool is part of that offering I was just talking about, but the concepts are universal. Don't think you have to buy what I'm selling. It's just think about the fact that just because your losses are low now, some of that's going to come back. And so for most, well, for all the clients we're running today, it looks like peak losses are going to be Q1 or Q2 sometime mid next year, given what we can foresee at the moment. Okay, so this is one thing to keep in mind. And then a related issue, which you've probably already talked about at your institution, is savings rates. Those are also off the chart. Here's a percentage change year over year on deposits for all, this is commercial banks, it's coming from Fred. And it's up at the level of 22% savings growth, deposits growth. Now, if you're a credit union with that much more in shares coming in, then suddenly your loan to share ratio is dramatically different than it used to be. Your net capital ratios are way off from what they used to be. NCUA has already said, don't panic. We know about it. We're not going to come beat you up on this right now. But then there's the question, where does it go in the future? How much of that is just hoarded cash because people aren't really spending yet, but they will? In 6 months or a year, they're going to look at that pile of money and say, hey, time to build on, remodel the house, or time for that new car or something else. That savings could quickly turn into borrowing. And so these ratios could change pretty quickly. And the question is, how do we plan for that? And so how much of this savings is only temporary? And we can address that the same way that we were looking at that overlay tool for losses, looking at what does the model say savings should have been right now? And you can do this yourself. So if you've got some baseline projections, what should savings be under these interest rates? What are they given these abnormal situations? And that difference is kind of savings that could disappear. And so how do you plan for that shift that may come over the next year? Well, then let's talk about metrics. And I think, Walt, this is where you and I have discussed that one of the things to make certain of is that you have those key metrics for your institution when you sit down to make your strategic plans. This screenshot comes out of our software again, but the list of metrics here, you can find, the list of key metrics from CUNA, NCUA. Every different group has got a list, and they're mostly these things on the screen that trying to keep an eye on the health of the portfolio. And this is where, when you talk about setting targets and setting thresholds for changing your mind, it's like these may be good metrics to look at as you consider what your actions are going to be, and when will you know that you're out of bounds of your original plan and are going to have to make a change. These are the same points that we had on the earlier slide at the beginning of this presentation. And you saw that, strategic planning, Walt gave a great overview of what you normally do, just the different points of discussion and process. And in COVID-19, this is just a recasting of that on how do we deal with the COVID-19 crisis, planning for the new normal uh, during and after the crisis. How do we look at each moment in the crisis? Really, data is key. And I've never spent so much time in my life digesting data, reading articles from economists, looking through different graphs and charts to try to understand where we are. And I think, um, in fact, my experiences with credit unions these days is that it's the most data driven it's ever been. That in the last recession, there was an awakening to the value of data and forecasting. And this time around, everyone we talk to is working on their dashboards for business intelligence and economic factors and all these things and getting into forecasting. So I think that's great. Um, as far as addressing your dysfunctions, I gave just a couple of examples of the kinds of challenges you might have around charge-off volumes and loan volumes, deposit growth. Quality shifts are another key one, and there's a whole bunch. And you'll have many operational issues to deal with through all of this as well. So, this is definitely the time to be honest and open about those challenges. And there are going to be too many things to deal with. And I had this discussion with someone yesterday. Sometimes the list is enormously long and you feel like you can't possibly get it all done. You just pick the most important one and keep going. Take it a piece at a time.
This Albert Einstein story I do think is relevant. Everybody knows who he is. Everybody knows he was a fairly smart guy, one of the smarter guys of the century, the 20th century at least. When he started out, he was a first level patent officer, Swiss patent officer, got bored with his job, tried to teach college, tried to get a job teaching high school, couldn't get hired, he got frustrated, decided to take a year off and write a couple of scientific papers. And, most of us who understand anything about science and Einstein know that at least 3 of those 5 papers that he wrote that year were pretty impressive and pretty groundbreaking. And in that community at the time, he was a young guy, put out these papers, and of course all the scientists of that time said, who's this kid think he is? Why does he think he solved this problem? And that was in the early 1900s. Well, it took him several years to literally get recognized as the genius that he was. And by the time he got into the 1930s, he is now at a college. He is a professor. He is teaching college. He's well recognized. He knows, what's going on in the world, and people know who he is. And he's sitting behind his desk one day, and one of his young teacher's assistants comes in, all flustered, waving his arms, going, "Professor, I'm sorry, I'm sorry." And Einstein takes a little draw on his pipe and puts his hand down. He just says, "Just relax. What's wrong? What's the matter?" And the kid says, "We issued the midterm exam, and all the questions are the same as last year's exam." And Einstein just kind of reflectively sat back in his chair and said, "Don't worry about it. All the answers are different." And I'm giving you the short version of the story because we're on online and so forth. But think about that. All the answers are different. And here's what I know about strategic planning as we go into these sessions, and a lot of times we talk about the same things over and over and over again, or they have the same issues, or you have, a board member that has a certain bend and he or she always wants to hammer on this one point. And you got to take some time on all the things that come up, and we need to talk about all these things. But just keep in mind, especially now, all the answers are different moving forward. A lot of these things that we think we know, that we might assume are going to happen, we just don't know right now. So especially in times like these, this is a great time. It's a great opportunity to make some changes to your process if you feel like you need to do that. Bring in some new thoughts, some new ideas. I think the scenario planning is a great way to maybe stir up some change. And again, that's what strategic planning is all about. And then, another great quote of his, and he's got a lot of these attributed to him, but he actually did say this. He said, "Look, we're not going to solve today's problems by using the same kind of thinking we used when we created them. And we're not really creating a lot of problems for ourselves as credit unions, I don't believe, in the industry, but there are a lot of issues out there and a lot of concerns. And this is a great time to just kind of sit back and maybe take a little bit different approach to things as you move forward. It just can't hurt. So I would just implore everybody to consider that. That's my ending, Joe.
That's great. And Walt, while you were getting reconnected, I just made a comment that I've seen such a shift in credit unions between this recession and the last recession and the time before that, that they are getting more and more data driven, more and more analytical, and looking at scenarios and forecasts. It's a dramatic change in behavior, and I think it's for the best. We live in a world where it's not an option to be data driven. We have to know what's going on. So with more data comes the ability for new thinking, as you said, and new insights on how to run things. So I think that's all very good for the industry.
Good.
So those are our prepared materials. Feel free to reach out to either myself, my information's here, or to Walt, and we look forward to following up with you later. If there are any questions, we're happy to hang around. We'll keep this line live for a while, so anybody who wants to hang with us, ask or type out a question, we'll go over that. But I appreciate everybody joining us today. And Walt, thanks for your time. It was great getting to do this webinar with you.
Absolutely. Thanks, everyone.
All right. Thank you. Take care.